Hi everyone. So today we have with us Fabian. I actually met Fabian last year and he was the one who started me out on my options journey. So I've always been doing value investing and stuff, but I never really gotten to know options, and it was quite eye-opening experience. A lot of times when I initiate a position now, I do so through options. The simplest way is to sell a put option, whereby it brings down my purchase price. And a good thing about Fabian is that whenever he teaches me any concepts about options, right, he will use a real life example. And today he's going to use the example of Pinduoduo, a rising star in China. It's getting really, really huge e-commerce company whereby people go on and buy products. I'm not going to take up any of more of your time, so I'm going to let Fabian take it away.
Hey, thanks, Thomas. So I mean, like today we are going to share about like Pinduoduo lah, and of course, like recently you all know that a lot of the Chinese stocks, they have become like sold off due to the regulatory kind of like fears of regulatory risk lah. Yeah, especially in China, it seems like everything seems like pretty uncertain, right? Especially right now. So I'm going to cover through like some like different strategies that you can use to take advantage of this, like volatility, and of course like low prices lah. So without further ado, like let's go lah. Okay, so in a sense like so essentially today we'll be covering mainly four things lah. First is of course like an overview of what like Pinduoduo already is, and then we'll be covering three different strategies to actually like take advantage of this volatile period lah, through options lah, So let's go. Okay, so in essence, right, like Pinduoduo, what this means is like it's just like an experience of like a team purchase lah. And essentially it's like a platform, like an e-commerce platform that allows people to group together to make bulk purchases. And one advantage of this is that it kind of like serves the tier 3, tier 4 cities like very, very well, because like these cities are like super rural, super inaccessible, and then it allows users to get together to make bulk purchases, and then you can just like just deliver one shot. It's quite like unit economics friendly. I'm not quite sure if I'm using the proper term, but so it's like in Singapore, it's like you just imagine like you purchase your items online on Shopee, but instead of it delivered to your house, it gets delivered to like maybe your nearest post office, and then you just have to collect from there. Of course, like it's like slightly more mafan for you, but for the person shipping the goods, they can just like dump like a huge quantity of goods over there, and then people like so-called collect themselves up. So that is roughly an overview, and in Chinese, like ping means like together, and then Toto is like more savings, more fun, that kind of stuff.
I think that's a great introduction to the business model of Pinduoduo. Maybe I just add on a bit. The company was founded in 2015 and IPO'd in 2018. But what's amazing about this company is that the amount of active users within 5 years actually surpassed that of Alibaba, which was previously the leading e-commerce platform in China. The good thing about this is like what Fabian has rightfully said, it targeted the third tier and fourth tier residents. Their monthly income is around $160 per month. So what the value proposition of Pinduoduo is that they are able to offer merchandise that's way cheaper than other platforms by letting consumers buy directly from manufacturers. So they cut out the middleman, they cut out advertising and all the other costs. So what you're getting is really wholesale costs. And why were they famous with third tier and fourth tier and beyond? In China, they call it the e-commerce for 五怀外的第一电商, meaning like the only e-commerce platform that can really penetrate these really, really poor regions, largely because they are able to fulfill this last mile delivery. As you get into the more and more rural areas, really where all the farms is, right? Logistics becomes super costly. And what Pinduoduo is they group all these orders together and they send it to one of the leaders there, and this leader will handle this distribution, which is why they became wildly popular in these areas. They have since made their way into tier 2 and tier 1 cities, but this was where they really come from. And I think not many people know this. It's not in the prospectus, but they actually started out as two companies. One is our Pinduoduo, and another one is called Pinhaohuo. Pinduoduo has always been a marketplace. A marketplace means a place whereby it allows merchants to come on to sell their products to consumers. Whereas for Pinduoduo, right, it's direct sales, meaning Pinduoduo will own the products and they'll sell directly to the consumers. And the story back then was Pinduoduo was actually a platform for them to test out which products were really good. And when they have the data to find out which product is selling super well, right, then they will put it to Pinduoduo, whether they want to sell it off themselves. But lo and behold, of course, when you're a marketplace, you're able to scale much more rapidly. And within 1 or 2 years, they realized that more than 99% of their revenues were coming from Pinduoduo. And that's where they decided to merge Pinduoduo and Pinduoduo into Pinduoduo, which is a much stronger brand. Today, they still do some direct sales for certain products that's not commonly found by merchants. So like, for example, you are unable to find a certain brand of tissue paper sold by merchants, third-party merchants, then Pinduoduo will come in and provide this product. Yeah, so maybe I just give the time back to Fabian, but that is just a part of interesting part about Pinduoduo as to how they started out.
Yeah, actually that's like pretty interesting information. Like, because I never really like dive into like Pinduoduo as deep as
The
you
history,
are.
right?
So, yeah, but I think like understanding the history really like gives us a lot of like insights as to like probably like the trajectory ahead and stuff like that. Yeah, so like you're absolutely right. Like one good thing about Pinduoduo is that the like among like the China e-commerce companies, they do tend to have the most number of active buyers. And if you look at this like article from Seeking Alpha by Canon Mail, like actually did a comparison of like Alibaba, JD, and Pinduoduo, and they kind of like found that even though like Alibaba has like the highest gross merchandise value, like Pinduoduo has the most number of active buyers, and it's probably because of like their targeted like customer pool, and of course like their value proposition to these customers as well. Yeah. Okay. So yeah, just like just taken like some like on the surface highlights, some on the surface numbers with their recent quarter. It's like you can see that their growth story, their growth trajectory, it's like has been pretty amazing so far. Yeah. So in a sense, like we can tell that like this business still kind of like has a long runway ahead when it comes to like their e-commerce in China lah. Okay, however, if we look at the climate right now, you can see that there's like a lot of fear like regarding like investing in Chinese companies because of like the regulatory risk. Like recently, Alibaba has been hit by the regulatory risk, and most of the Chinese companies like they tend to follow suit. So what we can see over here, it's like okay, so over here at the bottom we can see like roughly the enterprise value of Pinduoduo relative to its next 12 months sales. So in the earlier parts of 2020, we can see that because of COVID, yes, traded at about like 6.6 times, 5 to 7 times its like next 12 months revenue. And after its kind of like business model kind of like took traction, partially helped by COVID, like for the later part of 2020, you can see that it's kind of like trading at about 10 to 15 times enterprise value over like next 12 months sales. And in fact, at the start of this year, where there was like a lot of optimism surrounding like growth stocks, it has traded like at a multiple of like 15 to 20 times as well. But right now you can see like this there's this sharp correction in April, and basically all the valuation multiples all start to plummet. And right now Pinduoduo, it's trading at about like 6 times its next 12 months multiple, which okay, we won't know how low it can go, but at this multiple, I think it's like reasonably quite cheap already. It's almost as if price, like COVID's multiple like that. So yeah, so because of this, like it's kind of like appealing like to just take a look at it. Yeah. Okay. So with that, we'll just like discuss some like option strategies that we can actually deploy lah. Okay. So
right. Before we move on to the option strategy, I thought you mentioned a very interesting point just now, which was Alibaba has the highest amount of gross merchandise value, and then Pinduoduo has the largest amount of buyers. Maybe I just talk about why they have grown their amount of buyers on their platform to such a large pool within 5 years, like super short period of time. They managed to achieve what Alibaba took many, many years to actually achieve, despite being an e-commerce player as well. Apart from the social aspect, they really introduced the element of gamification onto their platform. Maybe I give one example or maybe two examples. So one thing they have is called 砍价, this price slashing function on their platform. And a lot of deals, like for example, you want to get a Levi's jeans, for example, you are able to slash the price down significantly all the way until it becomes free even. What you need to do is that you need to invite a ton of friends. The more friends you invite, the cheaper your product get. While it sounds like they're giving stuff away, like for example, you can buy a Levi's jeans for $10 or even you get it free if you are able to invite enough people. What this effectively does is that it brings a lot of users onto their platform. It's like, let's say today I want to get something. I'm going to text Fabian. I'm going to text maybe Kelvin and a few of our common friends, whereby we tell them, hey, I need to buy something. I need to buy this Levi's jeans and I want the price to really go down. Help me. And as my friend, you are usually sort of obligated to come and help me, and it doesn't cost you anything. You just need to come in, fill in your details, your name, your birthday, your email, your WeChat, and all that kind of stuff. And Pinduoduo will then capture you as a user, and they will be able to start sending marketing information to you and start pulling you into the platform. So this is effectively bringing down their customer acquisition costs. So when you look at companies like Uber and Grab, when they have to acquire new customers, they start to give out a lot of coupons. They give out $10 coupons to new users in order to suck them in. Pinduoduo doesn't have to do this. With the 砍价 function, people will naturally ask their friends to come in and sign up for accounts. Another way they do this is through the lottery function. So Pinduoduo has these special deals whereby, for example, you want to get an airport, right? You want to get an airport, but the requirement is you have to get 40 people to pay $5 for this airport. The thing is, if in event whereby you don't win the lottery, they will refund this $5 to you. It sounds like Pinduoduo is doing something stupid, right? It's either you win or you don't lose anything. You get back the $5. But the thing is, they are able to start pulling a lot of users onto their platform. I will be sending a text to Fabian. Hey, Fabian, come in and fill in your information, and then we stand a chance to win lottery for free. If we don't win, we get our money back. If we win, we just pay $5 for the airports. And it is a lot of these really brilliant strategies that really help them to grow so fast within 5 years. Yeah, so this is the brilliance of Pinduoduo and their secret sauce on how they're able to grow that fast. Is their competitors trying to copy them? Yes. Alibaba started Taobao 特价版, which is Taobao special deals, and JD has this JD 品购. But the thing is, on concept, this is simple, this is easy to replicate, but it's tough to copy a product's soul, if you would. Like, there's a lot of people trying to copy Facebook, but it is tough to replicate that kind of interface, that kind of spirit, like how you gamify the whole platform. And this has resulted in Pinduoduo really growing very, very quickly. But of course, that's not to say that the company do not have problems. The company actually do have a lot of legitimate concerns around it as well. Like, for example, there's quite a lot of scammers on the platform. Similar to when Alibaba first started out, they had to stamp down on piracy, like fake LV bags, or when people buy things but the products were not delivered, or they sell those very low grade milk powder. These are still pretty common on the platform, and the government is really clamping down on them to get them to really clean up their act. They have to start cleaning up some of their merchants. So just bear in mind that there's some risk surrounding Pinduoduo as well, even though the company has been executing super well. Yeah, so back to you on the options part.
Okay, yeah, that's like another like super insightful deep dive. I think like Shopee, like talking about like gamification, I think it's like also like common to Shopee, but yeah, that's another topic for another day. Yeah. Okay, so with that, right? Yeah, here are some like like option strategies that we can use as alternative to like directly purchasing stuff. I mean, it's nothing wrong with purchasing going to the market and purchasing stock itself. Yeah, but some people they might actually choose to deploy options because either they want the leverage or they want to put forth less capital, and stuff like that. Okay, so so here's an very brief introduction to options lah. Okay, so essentially the first strategy is just directly buying leap calls. Okay, so leap calls LEAPS kind of refer to just the long term kind of calls. So these are calls with a very far away expiry date, and essentially call options are basically contracts that give you the right to buy a stock at a certain price. Okay, so maybe a rough example right now is for example, if Pinduoduo is $109 per share right now, and what we can do is we can just buy strike 60 lead call for $55.70. So what this means is you're purchasing the right to buy the shares at $60, and in exchange for that, you pay a slight premium over the current share price. What would you pay over the current share price right now? Okay, so if let's just say we pay $55.70 for the right to buy the shares at $60, what we are effectively doing, right, it's that we are paying, we are kind of our break even, it's kind of buying the shares at $115 plus, right? Yeah, so so the question is why would people want to pay the extra $670, right? Okay, so you can see for stocks, right, let's just say you want to buy 100 shares of Pinduoduo, how much will you need to cough up? You need to cough out almost 11K lah, right?
Yes.
But for options, it kind of it does reduce the capital upfront. So in a sense, right, it's leverage in a sense, but that's why we don't do a full position on it. Yeah, so it allows us the exposure to 100 shares with about half the amount now. Okay, so it's very important we do not employ lead calls just anyhow. Yeah, because if we employ anyhow, it's leverage, you can lose a lot of money. So it's very important to buy when there is only a very huge margin of safety, when there's a dip. Because if by come 2023, if let's just say the share price it's less than the current share price right now, you lose money lah. Yeah.
Right. So the reason for buying leap calls is essentially because you don't have to put up so much cash upfront.
Yes.
One call option would equate to 100 shares. And for Pinduoduo case, right, 100 shares require you to put up $10,900 because the current share price is $109.
Yep.
And also because when it comes to leap calls, is there any other reason why you want to buy such a long duration call option?
Okay, there's this saying among people who buy options is that if you buy short-term options, it's kind of a bit speculative because you won't know how the market will react within 1 or 2 weeks or really 1 or 2 months. Yeah, but if you buy a longer dated call, it tends to give you more opportunity because there's chance to actually ride on the growth of the company, as well as within 2 years, it's quite possible that some of the regulatory fears might actually subside. Yeah, so you have reversion to the mean plus a longer period for the company to actually compound as well. Yeah.
Right. So in a way, is it right to say when you buy a leap call option, you are sort of betting on a catalyst happening, and in this case, it is the regulatory climate going back to normal, and hence after that, the share price will revert back to the mean.
Yeah, that's one of the catalysts, and of course the second catalyst is the business. As from now till 2023, hopefully it still continue to grow its users, get more revenue, stuff like that. Yeah.
Right. This one I also noticed you are buying a deep in the money call option. Is there a reason for going so deep into the money?
Yeah, now that you highlighted it, yeah.
Right.
Yeah. So in this case, right, yeah. Like what Thomas mentioned, this option is pretty deep in the money, and one reason for deep in the money options is that they tend to have a lower extrinsic value. Okay, so imagine like when you buy an option, right? You're paying a premium, and that premium consists of two things. Okay, because remember, options, you have the right to exercise your option and buy the stock at a discount right now. So first is the intrinsic value, which is the discount. So imagine if we buy like a strike 60 call option, right? Yeah, right now the intrinsic value, if we have to exercise it, how much discount will we get? You get to buy the stock $49 cheaper. Why $49 cheaper? It's because it's 109 right now, and we get to buy it at strike 60, and we did buy it at $60. So in a sense, there's this $49 like discount or intrinsic value already baked into the premium. However, it doesn't just make sense to like just sell options as at like $49. Otherwise, what people do is they'll just spam buy options, exercise it, and then like just make money in between, right? Yeah. So most of the time, options they tend to be more expensive in a sense that they carry a speculative or extrinsic value as well. So in addition to the $49 discount, you are paying a premium of $6.70 more. Yeah, and this $6.70 is like to it's kind of like a speculative value because if Pinduoduo doesn't move at all, let's just say like in 2 years later, it's still the same price. This is how much you'll be losing, which is $6.70. Yeah.
Right. Correct me if I'm wrong. The extrinsic value, another way to put it is like it is actually for the time value, right?
Yes.
Because you get to sort of like own Pinduoduo for up till January 2023, which is about 1 year plus, close to 2 years, right? 1.5 years, I think. Yeah, so it is sort of like is you're compensating the seller of the call option $6.70 for this duration of time. And as time passed by, as the date draw closer and closer to January 2023, this extrinsic value will start shrinking. I think the extrinsic value is also determined by volatility, if I'm correct.
Yep.
Yeah, so it's largely a factor of time, the period, the duration to expiry, and also based on the volatility. Yeah, so by paying a large amount of intrinsic value, right, effectively, you are paying less for the extrinsic value.
Yep. Okay, so in essence, right, like, this is like, just to a rough overview of like, buying lead calls. Essentially, it's just like leverage. And then, there are some things to consider, like, before you actually buy a lead, because like we mentioned just now, it's actually like leverage, and you don't want to anyhow like employ leverage because it can cut you both ways as well. So first thing we need to be sure is like the quality of the company. Yeah, if you likewise, if you buy stock on a lousy company, like you're probably going to lose money, and if you deploy options on a lousy company, you're probably going to lose like double, triple the money, or like all of the money lah. Yeah. So the first thing is like make sure that it's a quality company in a secular uptrend lah. Yeah, like for example e-commerce, that kind of stuff. Secondly is like you need to buy when there's a margin of safety. Yeah, because if the stock plummets over the longer term, you actually will lock in your losses. Yeah, and of course, like as it goes with lead options, right? Like if your thesis is intact, as long as the company is not like doing anything silly, no need to worry about like volatility. It's possible like when you buy lead options, right? Like sometimes you might actually see them lose like 50% of the value in the short term before going back up. Yeah, because like let's just say like in this case there's 2 times leverage, right? If Pinduoduo drops to like like maybe about 75 or 80, yeah, your option is gonna like lose about 50%. Yeah, but that is if in the short term lah, but in the long term, if it goes back up to like maybe 120, 130, yeah, overall you're gonna make money still lah. So don't worry about that, like and of course like don't over allocate. Like I would say it's a bit risky to have like like 100% of your portfolio in deep in the money options because
Right.
the moment like it goes half, the share price cuts in half in 2023, you lose all of your money. So ideally, right, like when you buy the options, it's best to like keep it like maybe 10 to 15% lah. Yeah, and with that small little 10 to 15% of its portfolio, if it actually grows, it becomes like 20, 30%. No? Yeah, and that's good lah. And if it doesn't grow, you can just
Yeah, I
can
think
just
this
like
is
let it
an
expire
important point
worthless.
because while buying deep in the money call options resemble buying a stock, right? The problem here is there's a time element to it. So in event whereby the government regulation lasts more than 2-3 years, then the value of this option is likely going to expire worthless. I mean, if the share price don't exceed your strike plus the amount of premium you paid, then the amount of money you paid for that call option is just going to go to zero. So just take note of this risk whereby if the stock price don't go in the direction you're predicting within this short period of time, then you could potentially lose everything unless you start doing creative stuff like rolling your call options out and stuff like that. But this will introduce an element of stress because you would be concerned about the clock ticking. Yeah. So
Yeah.
when it comes to portfolio allocation, allocate the amount whereby you are comfortable to lose, and most importantly, you must be able to sleep at night in order to make good decisions.
Yeah, I mean, like, to add on to that point, right? Actually, for me, right, like, if I should say, like, I have stock position in Pinduoduo, and then like, yeah, for me, I'll just buy one call option 2023, and then I'll just sleep on it. If come 2023, let's just say, like, uh, it expires what first. Let's just say I touch wood, it goes to 60, and I lose all of my premium. Yeah, normally people will be like very sad, right? But for me, actually, I'll be like quite happy lah. Why is that so? Is because like I can repeat this strategy again. Yeah, provided the company is the quality still remains intact, nothing wrong with the business model lah. Let's just say like there's maybe a COVID in 2023, for example. Yeah, so what will happen, what I'll do in 2023 is that, okay, you know what, I'll just let this expire worthless, and then I might repeat this strategy again. So imagine, right, if I repeat this strategy, like, let's just say I buy like, in 2023 becomes 60, and I buy a strike 30 call option, right? And then it goes back up to like, maybe 120, right? Yeah, I will still manage to profit from that call option, which I managed to buy at a cheaper price just because the share price has dropped. Yeah, that's provided that there's nothing wrong with the business inherently. So yeah, so if need be, can this is something you just buy, go and sleep, wake up in 2023, whatever it is, whatever it is. So that's one way to do it. Yeah. So, and if need be, you can enter in trenches. So if it really like, there's a sharp correction and, there's nothing fundamental really changed, you could consider like deploying a second trench. Yeah. Yeah. So yeah, that's about it. And yeah, so okay, so the thing about LEAPS, right, is that it's just like buy a call option and then just sleep on it. It's like very zen, it's like very like long term investing, but it's just like leverage long term investing. Yeah. But sometimes, right, like some of us we a bit itchy finger. We also like want to trade a bit. We want a bit of cash flow. Yeah. So yeah, so actually, when we buy a call, because it's like a leverage stock position, some brokers they actually recognize it as collateral. So yeah, so actually, right, you can actually sell some calls against it for cash flow. So this strategy is what we call the poor man covered call. Yeah. So in essence, right, poor man covered call is like a two-component kind of strategy. So the first, it's like what we discussed just now, it's just buying a deep in the money long-term call. Why we buy a deep in the money long-term call is because it has lesser extrinsic value. As the deeper in the money options, the deeper in the money and option goes, the lesser the time intrinsic value it has. Because yeah, these are options with most of their value being recognized as intrinsic value already. Yeah. So one way to actually take advantage of it is to actually sell short-term calls periodically against using our lead call as collateral. So what this like one example is like, for example, you buy a strike 60 lead call at 55.70. Remember that example just now? It has kind of like about 40 yeah, 40 something dollars worth of $49 of intrinsic value and about like $670 of extrinsic value, right? So what we can do is, we can sell a out of the money call to try to recoup back our extrinsic value. Okay, so how this works you notice is that right now we are selling a call that expired at the end of next week. So this is us trying to say that here's our collateral, but if it goes above 116, you can take the rest. And in exchange for that, I get $1. So yeah, because remember like our lead calls are like leverage stock. So if it goes up like by to 116, right, it'll go up by about like at least $7. So our option position it will not go up $7 per share, but it will go up close to $7. So you might see profits of like $6, something like that. Yeah. And in exchange and coupled with the $1 premium, right? If it actually hits there, will we be glad to sell? So there's like two schools of thoughts on this. So some people they don't like to cap their upside, they have to hold the stock and ride it up forever. So if you're gonna do that, right, like that's not this pro-main covered calls is probably not the strategy for you lah. But if you're the kind that you want cash flow or waiting for the share price to increase, you can consider this. Yeah. So in essence, right, what we're going to do is to sell short-term calls periodically using a lead call as collateral. And the advantage of this is that we are able to get cash flow from the short call. Okay, because you can see the $1 that we are collecting, right, it's just totally extrinsic value. Remember the 116 call has no intrinsic value. You buy a call right now and you try to exercise it, right? You actually be buying the stock at a price that is higher than the market price. So it does not make sense. So it's like, you're selling to people who are speculating that it will run up. Yeah. So one advantage of this is like, you can get the cash flow and of course like, you're offsetting your extrinsic value. In fact, if you just do a simple back of the hand calculation, if you do this for like about 7 times, we have fully paid for all of the extrinsic value in our call option as well. Yeah.
Right.
So, but of course, like the cons of this is as usual, the leverage downside comes from buying the deep in the money lead call. So if you actually overpay for your lead call, you can actually suffer losses on your account in total, in general, which your $1 will not be able to make up for it. And of course, like the second con is like your partially capped upside. Yeah. So it's it's trying to say like
super painful. Like if you start to see your position run up, but because you sold a call option, right? Typically your position will be called away. So in essence, this move is actually smart in terms of generating cash flow. First, you buy a call option. It sort of entitle you to own 100 shares, and because you own these 100 shares, right, your broker will allow you to sell a call option, and from this selling of call options, you will be getting back the premium. The only challenge here is like if Pinduoduo suddenly snap back to maybe $150, then your upside will be capped severely in that sense.
Yeah, you still make a profit. So some people like they don't mind, like but if you are buying Pinduoduo like for the long term, for the long haul, it might run contrary to your investment objectives. So just okay, I mean of course there's ways to sell which we'll discuss later, but yeah, it tends to partially cap your upside. Yeah, because it's still possible to roll your call option. Yeah, we'll talk about rolling later, but yeah, that's a good point that is being brought up. Yeah. Okay, so with that, right, with pro-main covered calls, right, yeah, there's 3 things to consider. Okay, so the first is like what you call like the safe strike to sell calls again. We don't want to be selling calls at a strike that is too low because like it doesn't make sense. It'll turn our position into a bearish position. Yeah, which is And the second thing to note is like the weeks to expiration. And then the third thing is like the premium that you want a week. Okay, so this again, right, is for people who want some cash flow or waiting for their position to go up and don't mind capping the upside. Yeah. Okay, so we give an example. Okay, so let's just say we buy our call option, we pay about 5.5K for it, and there's 79 weeks to expiration. So in essence, right, what this means is that if you let's just say it goes all the way to 60 okay, the amount that you're actually bleeding out of your account, right, is like about $70 per week. So this means that come 2023, if your option like people thought like goes to 30 or 40 or 50 or 60, right, it expires worthless, right? Yeah, this is the damage that is being done to your account on a weekly basis. So with pro-main covered calls, right, one way like people can try to do is like just to like, go to the option chain. Yeah. And then like, just search out whatever call option that is worth that premium and then just sell it. Yeah. The logic is like, if you do it for 79 weeks, you make back your entire 5.5K and totally de-risk your position lah. Yeah. But in the real world, it's often like, easier said than done lah. Yeah. Because like share price tend to be quite volatile and the option premiums tend to change your share price as well. Yeah. So, okay, like the first criteria, like personally that I will use lah, okay, is like is to establish a safe strike. So what this means is like, I only sell a call, right, like that is above a 115.70. And why 115, right, is it's because, right, that's like my break-even price. So I only want to sell like, a call when I know for sure, like, if it hits that price, there'll be at least $55.70 worth of intrinsic value plus extrinsic value in the call option. So there's some people, right, like, they like recently, I think there's some examples of people like buying Tesla before the S&P inclusion. So you're like buying long-term 430 calls and you're selling 430 calls against it. So in this case, right, like when Tesla suddenly surged up, they lost quite a bit of money because, effectively they are paid, the amount that they pay for the Tesla call option, right, effectively like, they cannot gain back already. So yeah. Okay, so yeah, what this means is as long as the strike price is above 115, it's kind of like safe to sell. So if you sell it and it hits, right, you confirm won't lose money. And yeah, yeah.
Right. So you recommend selling at above break even to ensure that at least you make a bit if
and you
it
can
should
sleep at
shoot up.
night also.
Right.
Yeah.
Okay.
Yeah, and of course, like ideally, we also want to get about 70.5 premium each week. Okay, so this one, right, is often an ideal case. But if like Pinduoduo goes down, right, sometimes you might have to make do with less. So yeah. So decide as long as Pinduoduo remains sideways, it should be manageable. But if it goes down, that's a different case. Okay, so one issue that like people normally face, right, is what happens if your short call is deep in the money. Okay, so with that, I'll just note that option chain. Okay.
And when you say deep in the money, it means the share price shot up, right?
Yes, correct. Okay, so with that, right, yeah, so this is actually like the live option chain for Pinduoduo, and then we can see over here, like these are like the prices for as of yesterday's close out, which is as of Wednesday's close out. So Pinduoduo closed at 109, and these are like the prices for next week. Yeah. So actually, right, if you go to the live example, if we actually just want to get like about 70 cents a week, right, what you can do is to sell the strike 118 call option. Yeah. So it's actually quite conservative. There's like a lot of breathing room for your so-called option to breathe. Yeah. But if let's just say maybe like somehow next week, it does a super run up all the way from 108 to 118 or maybe 123 or 25 already. So what we can do is we can do this strategy called rolling. So what rolling involves is just buying back our option and then selling another later dated option. Okay, yeah. So ideally you want to do it at the credit. So perhaps maybe like, okay, so let's just say maybe I bought a call option. Maybe I sold a call option, like maybe strike 100. Okay, so now that expires like maybe tomorrow. Okay, so you can see like yeah, maybe I just sold a strike 100 option and then now I have to pay about $9 to buy it back, which is very hefty right? Yeah. So what I can do, right, is I'll just pay $9. So kind of have like a $9 debit, and then what I'll do is like pick a like later date, such that maybe August, and then I'll sell the strike 105 call option for about like $9 as well. Yeah, so you can see what I've effectively done is open up like my upside from $100 to about $105. So it gives you like an additional breathing room. But in between now and August, I don't get to get any money from cash flow. So that's the cons of it. Yeah, it opens up your upside, but you don't get money from cash flow. So Yeah. So this is what I call rolling lah, to open up the upside. And of course, like when you roll, ideally you have to roll it like above the safe strike, which is above the break even of your position. Okay. So again, right, all this it's mostly for like like if you just want cash flow on a weekly basis, you're more of like a trading kind of like mindset. If you're investing like for the long term, you're buying this like leaps will just suffice lah. Yeah. Yeah. So this is like poor man covered calls in essence. Yeah. Okay, so with that, we go to the third strategy, which is actually a poor man covered strangle. Okay, so in essence, right, like if you have extra capital plus of course conviction, what you can do is okay, because just now we discussed poor man covered calls, which is essentially buy a lead call and then sell a call, right? So a poor man covered strangle, it's essentially like having a lead call plus a short strangle. So a strangle, right, in option terms is basically just selling a put and selling a call at the same time. And the logic behind that is like, when you sell a put or when you sell a call, right, only one of them will expire in the money, not both. Okay, so what this means is like, for example, if the share price is 109, what we do is like, we sell a strike 102 put and we sell a strike 116 call. Okay, what this means is that we agree to buy the stock at 100 if it goes below 102, and we agree to sell the stock if it goes above 116. Yeah. And essentially, right, what happens, I mean, of course, you'll be receiving some money for it, but what happens is that, the stock can't be both above 116 and below 102 at the same time. Yeah. So, for example, if it's above 116, right, we definitely need to buy the stock at 102, right? And if it goes down below 102, right, we get more stock. That's why I need the conviction, but definitely we need to sell it at 116, yeah. So a strangle is a kind of like a way to profit from both directions. Yeah, because like either only one of the options will be in the money upon expiry, not both.
Actually, in this case, the best thing that can happen is the stock price just move in between them and nothing happen, right? Because you're collecting premium upfront. So is that the best case scenario or?
Actually, this one will have to depend on your own trading, your investment thesis as well. Because for me, right, like let's just say if I'm okay to buy Pinduoduo at 102, if I'm okay to sell it at 116, right? Yeah, it's like no matter where it moves, I also win, right? If it hits 102, I accumulate more shares. If it's like 116, I'll be like, okay, good enough, we can go, right? If it stays in between, I get the money.
I see. Yeah. So ideally, you should be selling your call at a price whereby you think it is overvalued, and the put you want to sell at a strike whereby you think it is undervalued, and you don't mind becoming a shareholder at that strike.
Yes. I see. Correct. Yeah. So I mean, if we do a live case example, like a real life example, like based on yesterday's data, like for next week, right? Okay. Next week is a bit short term. You can do it like any duration. Yeah, but if we agree to buy the stock at 102, we can get about like $90 of premium. And then if we agree to sell it at 106, we can get another like $100 of premium as well. So altogether, it's just like 190 a week. Of course, you'll need more capital because you are agreeing to buy the stock at 102. So it's best that you have the cash set aside, ready to take assignment if it happens. Yeah. Yeah, but in essence, right, like you can see like the cash flow is enough to actually like, for me like cover my own daily expenses. So yeah, it's pretty decent. And of course if you go further out, like the premium becomes much more like at about 120 if you agree to buy at 100. And then maybe if you agree to sell at 120, you can get like, like the premium's pretty good actually. Yeah. So this one is like extra strategies you want to use it.
So I'm not okay. So the selling put one is quite clear because we already want to own at 102, so it's fine to sell at that price. But for the sell call, right? What if the price shoot up to 150? In a sense, I'll be losing a lot of money, right? If the stock price suddenly shoot up.
Yes. Yes and no, because let's just say it shoots up to 150, because it's covered, right? By your call option. So, whatever gains, okay, whatever losses that you incur by selling the call, you gain by,
Okay. So previously
yeah, you're
already
covered by
purchased
your
a
lead call.
call.
Yeah.
Right. Okay.
Yeah.
Understood.
Yeah. I mean, of course, there's some traders that, don't cover their strangles, and if they go to 150, they'll lose a lot of money.
But
Lah.
we would strongly advise against selling naked
against
call because naked call the
precisely.
losses you can incur is unlimited. So if you want to
It can
do
wipe
this
out.
strategy for cash flow, right, you need to make sure that you are covered
You have.
by either the
Yes.
underlying shares or by a leap call.
Yes, correct. And that's why it's called like, a poor man covered strangle. Like, if someone recommends you to do a short strangle while you're a beginner, right, just run away. Yeah,
Right.
it's too risky for an account, and of course, like, your brokers can prematurely close your position if like something like that happens, which can be quite painful also. Yeah, so don't do that, lah. I mean, make sure all your when you sell a call is always covered. Yeah, so okay, so with that, right, like okay, I mean, I have some of my friends like they ask me like, what strike should I actually sell? Yeah. So one way to actually look at is actually there's this thing called the delta. Okay, so delta in essence, right, is okay, like there's many users for it. It's kind of like an option Greek term. So like options, there's like different Greeks that describe different things about the options. But in essence, delta is just kind of like, the probability. In this case, delta will just be like the probability of the option expiring in the money or worthless. So basically, one delta options, right, tend to be very likely to expire in the money, and zero delta options tend to be like, very speculative, very far off the money. Okay, so with that, right, we can take a look at okay, I'm not quite sure whether my screen is like blocking everything, but okay, here's on Tiger Brokers. So if you let's just say we look at like different options, okay, we can see that, there's this delta. Takes a while for it to load.
Right. So in this case, you are trying to decide on the price to sell your calls, right?
Yep.
Okay.
Yes, correct. Yeah, I mean, but there's many ways to describe it, lah. But like some people, they might just like, every week just log in, sell 10% above the current share price. Yeah, and that's it, lah. So it's up to you to decide your own comfort level, lor. Some people, they really just want a bit of cash flow, lor. Yeah. So even some investors I know, like, they might just log in and they might say like, okay, I'm going to choose like, 1 month ahead. I'm going to choose Pinduoduo. I'm going to choose like the strike 150 option now. I just get $40 this month, right? But I'm happy already. If it goes to 150, I'm totally happy to sell the stock, right? Because I mean, like for all of our holdings, if it hits a certain price, you definitely be happy to let go. Yeah, so you could be ultra conservative like that, and $40 is good enough for you to like bring your family to eat a nice dinner, lah. So I mean, like why not, lah? Yeah. So at the same time, like some people like poor man covered strangle, right? Like, $40 in the call side, so maybe about like 150, and maybe about $40 from the put side. So maybe if it drops below 85, I'm also willing to get it, which is also quite a steal, So some people they might do that. Yeah. So this is some ways to get kind of like cash flow. It's $70 to $80 a month, but it's still money. Yeah. Yeah, so that's one way to kind of like choose. But of course, the cons is this, a large move in either direction can actually heavily damage your position. So, for example, if like Pinduoduo's management like do something stupid, like there's fraud involved, yeah, then you're gonna lose quite a lot of money, lah. Yeah. So just be aware of that as well. Yeah. Okay. So with that, in summary, lah, lead calls are a good way to profit when the stock market sells off, because it's leverage. It allows you to put like lesser capital up front. Of course, you pay a premium to that in terms of extrinsic value, but you get like the same amount of exposure as you would for 100 shares with just a lesser amount of capital. Yeah. So if you buy lead calls, just be careful, because if it goes down, if it goes against you, your losses can be amplified as well. So don't over allocate. And of course, like for some people who want some cash flows while holding on to their lead calls, they can sell instead of like, you know, foment-armored calls against it or waiting for the share price to go up. But of course, this comes with the possibility of capping the upside. And then lastly, you know, some people, they want to just profit both ways. So what they do is like, you know, sell put, sell call, and then like, you know, all scenarios they are happy then. But of course, just be careful, like don't over allocate again, because a large move can heavily damage your position, especially on the downside. Yeah. So with that, yeah, kind of like
Wow, this is awesome. I think a lot of us probably learned a lot today, like information overload. So really thank you for sharing all this. Now, is there a way for people to follow you or not? If they want to follow, is it Facebook or?
oh, actually I haven't like really created
Right, right.
any platform yet, but maybe
I
soon
see.
enough. Maybe we can
Yeah,
create a YouTube channel soon.
right. Okay, so
Yeah.
when you create a YouTube channel already, then I'll include your link in the show notes. For now, if you guys like what you just watch, do give this video a like and subscribe to the YouTube channel. And then when Fabian's YouTube channel is up, I'll definitely let all of you know.